Our final two topics are pretty brief. This topic is on adjusting entries. Businesses will need to periodically count their inventory to make sure it matches what is recorded on the books or in the system. Usually, this is done annually by an independent third party. However, some businesses will internally do an inventory count more frequently. You may have even been a part of an inventory audit before. This is done because even if the company keeps great records, theft can still occur, errors can still be made, and damaged products could be thrown out. When actual inventory is less than what we are supposed to have, we use the term shrinkage. We need to adjust our accounts to reflect the true amount of inventory on hand. The journal entry is a debit to cost of goods sold and a credit to merchandise inventory. We debit cost of goods sold because we are expensing the inventory that is gone. We credit merchandise inventory to remove the missing inventory from the inventory account. The amount journalized will be for the amount that is missing or damaged. We'll practice this now. This problem looks somewhat intimidating at first glance, but is actually quite simple. This is problem number 2. Nixit Company's ledger on July 31st, its fiscal year end, includes the following selected accounts that have normal balances. A physical count of its July 31st year-end inventory discloses that the cost of the merchandise inventory still available is $35,900. First, let's input the account names since they are the exact same as what I just showed you. The debit is for cost of goods sold. The credit is for merchandise inventory. Now, let's try to figure out the amount. Out of all this information given, we only need to find two numbers. First, we need to know what the inventory count was. When the inventory was counted, we found only $35,900 worth of inventory on hand. How much was there supposed to be? We can use the merchandise inventory account to tell us that. There was supposed to be $37,800 of inventory on hand. We obviously counted less than what was supposed to be there. The difference is how much is missing. When we subtract 35,900 from 37,800, we get 1,900. This is the amount that's missing. We expense it out and remove it from the merchandise inventory account. After this entry is done, the new balance in the merchandise inventory account will be updated to be $35,900, which would be accurate to what we counted.